Every single day, billions of dollars move through the options market. It looks like chaos, but hidden in all that noise are the footprints of the so-called smart money. I'm talking about hedge funds, institutions, and sometimes even insiders who know something big is coming. Most retail traders glance at an options scanner and just see a bunch of numbers. But what if you could read it like a pro? What if you could spot which trades are signals worth paying attention to and which ones are just useless noise? In this video, we're not just going to look at unusual options activity. I'm going to give you a repeatable framework for interpreting flow so you can actually understand the story behind the trades. Before we get into filtering and case studies, let's get crystal clear on what options flow actually is. Options flow is just a real-time record of large options trades hitting the tape. It shows us where big players are putting their money. Why does that matter? Because big money often wants to move quietly. They don't want to move markets against themselves. But when their orders are big enough, they show up as unusual activity. That's our edge, learning to spot urgency. Here's some quick vocab every trader has to know. Sweep. This is when a large order is split up and executed across multiple exchanges at once. It screams urgency. The buyer wants in right now and doesn't care about paying a slightly worse price. Sweeps often suggest the trader expects something to happen soon, like earnings, a news release, or a technical breakout. They're often viewed as smart money alerts, but only when combined with other signals. Block trade. This is the opposite of a sweep. It's a big, single order, often negotiated privately, less urgent, but still big money. Blocks often represent institutional positioning or hedging. They're usually placed quietly to avoid moving the market and can be part of complex multi-leg strategies. Sentiment. Scanners tag trades as bullish or bearish depending on how they were executed. Bullish means a call was bought at the ask or a put was sold at the bid. Bearish means a put was bought at the ask or a call was sold at the bid. Once you know this language, you stop seeing random numbers and start reading intent. Here's the biggest trap for new traders. 95% of options flow is just noise. Hedges, multi-leg strategies, people closing positions. If you try to follow everything, you'll lose money. The key is to isolate the 5% of trades that actually matter, the ones that point to smart money betting on a coming move. Let me walk you through 5 filters that completely change the game. Imagine this like a checklist. 1. Trade sentiment. We only want clearly bullish or bearish flow. Ignore neutral or complex trades at first. Conviction only. 2. Minimum premium. Focus on trades above $100,000. Why? Because that's institutional sized. A retail trader dropping $5K doesn't move markets. A $500,000 bet might. Just remember, a single big trade doesn't always mean a directional bet. It could be part of a hedge or spread. So always confirm with the chart or related flow before assuming intent. 3. Order type. Sweeps. Sweeps are urgent. They show someone trying to grab as many contracts as possible across exchanges before the price runs away. That's a signal of expected catalysts. 4. Days to expiration. DTE. Look for expirations under 30 to 45 days. Urgency matters. If someone spends $1 million on contracts expiring in 2 weeks, they're not thinking long term. They believe something is about to happen. 5. Moneyness, OTM. Out-of-the-money contracts are more telling. They're riskier, cheaper, and more leveraged. If smart money is willing to pay up for them, it's because they expect a strong directional move. With these 5 filters, you cut out the noise and focus only on trades that scream, "Pay attention." Let's put this into practice with a case study. Imagine you're scanning flow and you see this, a $1.2 million sweep of Nvidia calls. 2 weeks until expiration. Out of the money strikes. Bought aggressively above the ask. That's a textbook golden sweep. But what does it really mean? Here's the 3-step interpretation framework pros use. Step 1, context is king. Look at the chart. Is Nvidia near a key resistance level? Is it consolidating for a breakout? You never read flow in a vacuum. The chart gives you the backdrop. Now, let's take all those filters and apply them to a real-world example. Step 2, look for confirmation. Check dark pool activity or big block stock trades on the same day. If you see millions in shares being scooped up alongside bullish call sweeps, that's real conviction. 3, decode mindset. Why would someone risk over $1 million on out-of-the-money calls expiring in 2 weeks? They must believe a near-term catalyst is coming. Sometimes traders even layer multiple expirations, buying both short-term and slightly longer-term calls to manage timing risk while still betting on a near-term move. Maybe earnings, a product launch, or even a macro event like rate cuts. When you combine urgency, sweep, leverage, OTM, and short DTE, you're basically seeing the market shout, "Something big is expected soon." In this case, the thesis is clear. Smart money is positioning for a sharp move higher in Nvidia within the next 2 weeks. Before you run off chasing every sweep, let me give you some pro tips and warnings. Don't follow blindly. Smart money isn't always right. Sometimes the trade is wrong, or sometimes it's a hedge. Use flow as a starting point, not a crystal ball. Beware of hedging. A giant put buy might look bearish, but it could just be protecting a billion-dollar long position. Context matters. That's why it's crucial to cross-check with stock flow, dark pool prints, or even the overall market sentiment before labeling a trade as purely bullish or bearish. The golden sweep pattern. The elite trades to watch for are high premium sweeps, $500,000 to $1 million or more, bought at or above the ask with less than 30 days to expiry. Those are the ones that stand out. Risk management. This is speculative. Use stop losses, size positions properly, and keep it a smaller slice of your portfolio. Options flow should complement your strategy, not replace it. You can also set alerts for repeat activity in the same ticker. When you see consistent large sweeps over several days, that's often more reliable than a single isolated trade. So let's wrap it up. You now have a framework. Filter the flow to cut out the noise, interpret the signals with context and confirmation, and then decode the trader's intent. Instead of staring at random trades, you're now reading the market's hidden language, the footsteps of smart money. Now I want to hear from you. What's the most interesting, unusual options activity you've seen recently? Drop the ticker and details in the comments. Maybe we'll analyze it in a future video. And if this breakdown gave you clarity, do me a favor. Like, subscribe to Elite Trade Club, and tap the bell so you don't miss our next deep dive. Thanks for watching, and trade smart.